Our next talk is from Camila Russo, whose talk is titled DeFi 2.0, Community-Owned and Meme-Based. Camila is a journalist and an author. She's the founder of The Defiant, a great source that I read all the time, and the author of The Infinity Machine, which is the first book about the history of Ethereum. So we'll welcome Camila up to the stage, and I'll let you take over here in a second. Awesome.
Hello.
Hey, and before we get started, Camila, I want to make sure I can extract this promise from you. In the sequel to Infinite Machine, will ETH Online be featured maybe in an early chapter?
Oh my God. I mean, I will do anything to get a sequel out there, and that's a really small price to pay. I would love that.
All right, I will look forward to it. I'll pre-order it as soon as I can, and I'll let you take it from here.
Cool. Thank you. All right. Hi, everyone. I'm Camila. The founder of The Defiant, a content platform focusing on decentralized finance, and author of The Infinite Machine, the book on the history of Ethereum that's right behind me. Hopefully, everyone has been able to check it out. I will be talking about DeFi, or the shift that's happened in DeFi this year. Sharing my presentation. All right. So DeFi 2.0, community owned and meme based. So okay, there was a major shift in DeFi this year, and excuse my dog, Conga. She likes to participate. So I'm sure you all have seen the explosion that has happened in DeFi in 2020. But you know, it's been more than just reckless speculation buying DeFi tokens. There's been a more foundational shift in decentralized finance, and I will try to make sense of it in this presentation. So there are a few things that are going out of fashion and a few things that are going in. Things that used to be kind of the standard and pretty well accepted, like having a known team with a track record building in crypto or in the Ethereum community, are not as important as they once were. Having security audits and extensive testing, well, before it wasn't done 100% of the time, it was kind of a requirement or really kind of appreciated when they were done, especially by kind of the big projects in this space. Before, having venture capital funding was becoming really commonplace, especially after ICOs kind of ended because of the regulatory clampdown. So VCs kind of came in to replace them. Also, tokenless projects were held in really high regard, because I think it was like, because of the ICO hangover, people didn't trust tokens as much anymore. So projects like Uniswap, which launched without a token, were seen as, okay, these guys are in it for the right reasons. Like, they're not in it to sell a token and then cash out and make a quick buck. Really, before, it was more common to have concentrated ownership because of these reasons that I said before. VC funding was more common, an established team working on a project for a long time. These things led to allocations for teams, foundations, VCs. So concentrated ownership was also more common in pre-2020. And then initial exchange offerings and centralized exchange listings were also more common. In the second half of 2020, these things started to change. So instead of a known team, we had more and more anonymous founders and team members. A great example, of course, is SushiSwap with Nomi Chef. He or she is a character from from a game. Nobody knows who they are. And that was completely fine. And people poured hundreds of millions of dollars into the project without knowing who the founder was. Now it's fine to launch a project, I mean, it's never fine, but I guess the token holders and the community aren't afraid of getting behind projects that haven't been through audits and security tests. And this kind of testing production meme has really taken a hold of the DeFi space. Well, before there were VC rounds. Now it's no pre-sale. And then a big theme, obviously, is token incentives. So token rewards for putting liquidity in projects. And this is obviously known as yield farming, which has become hugely popular in DeFi and driven a lot of the value that's come into the space this year. 100% community-owned tokens versus concentrated ownership in teams and investors. And instead of initial exchange offerings, there are initial DEX offerings where DeFi projects list their tokens directly on decentralized exchanges like Uniswap and Balancer. And then the last important element that is in DeFi 2.0 is social virality, or memes. And we get a lot of kind of projects that are basically, an emoji, .finance, and that will attract tons of money. So here are examples of kind of what was more common in the past. These were DeFi giants pre-2020. I lost the Uniswap logo there. But Uniswap, used to have no token. They had centralized government. They raised millions of dollars from VCs, and the team are known and had a track record of building in the space. In MakerDAO, while governance is decentralized, Maker Foundation did control key pieces of governance. The foundation and VCs own a huge chunk of the Maker token. They've raised many millions of dollars from VCs, and again, they're a known team and a track record. So with this year, I think these two projects are a great way to show how this paradigm has changed. So with the previous examples, Uniswap and Maker, those kind of foundational projects in DeFi, they've also changed this year. Uniswap now has a token, and Maker is further decentralizing governance. They want to dissolve the foundation at some point. But these projects really kind of have changed the narrative and changed the paradigm. Yearn Finance was the first project in DeFi to launch a 100% community-owned token. That means that at launch, there was no investor and no kind of entity or team that had a pre-allocation of the token, and it became 100% owned by users of the platform. And this really kind of inspired the community and kind of raised the bar, so that all of the DeFi projects that launched after this, I guess, had to consider whether their token would be 100% community owned, and it has become something that the DeFi community and investors and traders are coming to expect. If it's not 100% community owned, at least it has to be, there has to be a small percentage allocated to previous investors and the team. For both, there was decentralized governance from the start. Token incentives became key. With Yearn, users were incentivized with tokens for putting liquidity in the protocol and in YFI liquidity pools. And with Yearn Finance, this was taken to the extreme because the UI was basically made to yield farm. I mean, it remains to be seen what token holders will do with the YAM treasury, and maybe, you know, the team will serve another purpose. But it started out as a project that was basically made to yield farm. Andre Cronje of Yearn Finance basically invented this test and prod meme, and YAM Finance also launched without an audit. The big kind of change that YAM Finance made in DeFi was that it was the first of these meme-focused coins. Like suddenly, when after the YAM Finance launched, this kind of sweet potato emoji was everywhere on Twitter, and it just kind of made it clear how important it is to have this kind of virality in a project, something that's really easy to communicate, to copy and paste. Everyone has an emoji on their at their fingertips, basically. So these two projects set kind of like a template for what DeFi would look like for the rest of the year. I mean, they came out in between July and August. And from then on, we've seen a real kind of explosion in similar projects launching. So to backtrack a little bit on how we got here, ICOs were the first DeFi use case, and there we saw kind of the extreme, at the extremes that people can go with speculation. MakerDAO launched kind of starting as the first kind of founding a project for DeFi. 2018, Compound and Synthetics launched, and DeFi continued to grow. In 2019, the space kind of lost that fear of decentralized autonomous organizations that Ethereum community had since the DAO hack. In 2019, with Moloch DAO and other DAOs that came after it, that kind of fear and stigma was shed. And then this year, you know, I think Synthetics had token rewards earlier, but Compound's token rewards with its comp token really supercharged token rewards because of how quickly the comp token surged, and because of the way that the rewards were structured. People saw huge returns in a really short amount of time. And so because of that success and the liquidity that it drew, every other project wanted to create something similar. So with that, the next big milestone, as I said, was YFI. Then came YAM, and then came all the explosion of DeFi, you know, forks and yield farming and meme coins and all of that. So that's pretty much, you know, how we get pasta tokens, hot dog tokens, kimchi, sushi, sashimi, and, you know, cream, a fork of Compound, Swerve, a fork of Curve, and all this explosion with really kind of, I'd say, irresponsible UIs claiming 1,000,000% yields and people just diving in. I also wanted to point out, you know, other fundraising alternatives are gaining traction, and it's not all about these kind of crazy token projects with for and non-profit DAOs, grants with Gitcoin, and this really cool experiment with Fair Launch Capital, which is kind of a no strings attached kind of loan for a project to fund and be able to have an audit at launch. So after all this kind of crazy explosion of innovation, of 100% community-owned tokens, no pre-sale, no audits, and decentralized governance at the start, what are kind of the takeaways? So obviously, you know, I think it's important to highlight the risks that have come from this huge kind of yield farming mania. I think for now, like one of the important dangers is having misaligned incentives. And so an important kind of a good example of what can happen with this was with SushiSwap, with the founder, Chef Nomi, kind of running off with sushi tokens. I mean, he did return them, but you know, it tells you what can happen when you're not incentivizing founders and teams to stick around and build for the long term. An obvious risk for when you have this sort of speculation and anonymous founders and launching with no audits is that you're going to get scams and hackers attracted to these projects. I guess, you know, a very recent one, which just shows you how crazy the space has become, is the example of Eminence, where it's a project that the Yearn founder Andre Cronje was working on, and it hadn't even been announced or released, but you know, somebody saw this Twitter profile. Andre had retweeted a tweet from the Eminence Twitter, and just with that, the hacker kind of found the contracts for the project after people had already minted Eminence coins. And again, this was a project that wasn't announced, and somebody like the hacker found it and stole the money. So it's this level of craziness that people are just willing to throw their money and crypto at whatever comes out with kind of yield farming and meme coins, and especially if there's like a celebrity DeFi founder like Andre attached. Another danger of decentralized governance is governance capture, which, you know, I think decentralized governance will be better than you know, the way things work with where just, you know, there's one company making the decisions for the protocol, but there's still the risk that one person or a small group of people can buy up all the tokens and just, you know, vote in a way that favors them. It's really hard to kind of prevent that. And then, you know, like we saw with ICOs, when there's a bunch of money coming in, when there's scams and hacks, when people are losing money, there's a risk that regulators will come in and put a stop to all this craziness. But, you know, for every risk, there's a way to see that as an opportunity. So where, you know, there is the risk of having misaligned incentives and founders running off with the money or simply not delivering. There's also the opportunity of coming up with better architecture for these DeFi protocols, you know, figuring out a way of maybe having a vesting schedule for founders, having some kind of salary, having a percentage of coins minted go to people working on the project. There are different models for this, but I'm sure that, you know, after what we've seen so far, people will start to make these changes so that building in the space becomes more sustainable. With the scams and hacks, I think it becomes more and more urgent to make sure that audits are affordable. So whenever you speak with these founders that launch without audits, the first thing they'll say is, you know, of course, I don't want to put my users in danger, but I don't have that money to spend on audits. So what am I supposed to do? Like, stop building, stop innovating? And I don't think anyone wants that in this space. So there's a big chance of, you know, having white hat hackers, having grants, having some maybe, I don't know, some genius developer take advantage of this lack of auditors and just offer their services a little bit cheaper than kind of the big security firms, and also market-based protection. So something like Nexus Mutual or options contracts with Open, all of these should become more widespread and stronger. And then with governance capture, I guess like obviously the opportunity with decentralized governance is having greater democratization of decision making of the protocols, and there are different kind of measures that you can take to make sure that your project doesn't get owned by whales. And then lastly, I think I think a good example of this is what happened with BitMEX yesterday. There's a risk of regulatory scrutiny, but because of that, I think the pressure is on to make sure that this space, that DeFi is actually decentralized, so that there's actually a regulatory shield for DeFi projects. The more that DeFi lives up to what it's supposed to be, which is owned by its users and non-custodial, so that protocols aren't actually touching users' money, they're not touching users' data, and they're controlled by their users, the lower the risk that it can become censored and taken down, like what's happened to BitMEX. So I think, you know, all this craziness, you know, it's bound to bring, yes, scams, hacks, but it's also bringing a lot of innovation, capital, attention to the space. So I'm sure DeFi will come out stronger from this craziness, and we'll look back and say, you know, and take away really great lessons from this, that, you know, will make the replacement of traditional finance a lot faster. So yeah, that was DeFi 2.0. Yeah, please subscribe to The Defiant, and yeah, follow on Twitter. And yeah, I don't know if there's any questions or if there's time for questions.
Great. Yeah, we actually do have a couple of questions if you've got a few minutes to stick around.
Yeah.
Great. So one question, and full disclosure, is a question from me. But, you know, one kind of thing you mentioned a couple times is, you know, anonymity of founders and both the benefits and risks of that. And one thing that people in the Ethereum space have been working on for a while are, you know, credible decentralized reputation systems. And I wonder if you could comment on, you know, how or whether, you know, good reputation systems could help alleviate some of the problems you discuss, and, you know, how those two areas of applications might evolve alongside one another.
I think that's a great point, because and it also kind of touches on the regulatory risk, right? Because so you want to be able to trust the people behind the protocol that you're putting your money in, but at the same time, founders want to protect themselves from potential regulatory scrutiny. So how to kind of balance those two things? And I think a great way to do that would be to have some sort of reputation system where you don't have to know the person's name, but you can have some sort of on-chain record, you know, where you can have some score or some trustless way of verifying that, okay, this person has been building in this space for a long time. They've been paying their CDPs. They have a good track record with their trades, or whatever, you know, it is that you'd want to check.
So a question from the chat. So it's obviously been an interesting and sometimes crazy year for not only the world, but for DeFi too. Yeah. And I wonder what event in Ethereum or in DeFi specifically surprised you the most?
I mean, I think like this yield farming craziness, I never saw it coming. Like, I think kind of a good sign of that was that I remember the day that the compound, you know, the compound released its token. And, you know, we all knew about this in kind of the Defiant contributor chat, and you know, I assigned kind of topics to write, and I had assigned the like Compound's comp token as like a really small blurb. Like I didn't see that it would make huge news. I was like, okay, so they're releasing their token. It's a governance token. Like it doesn't do much. Like it's not supposed to be traded right away. So I don't know, like I really didn't think it would be a big deal, but obviously the thing kind of exploded and it went up like 10 times, I guess, in value in one day, and drew in tons of liquidity. So yeah, I definitely didn't see a yield farming craziness coming. Like it just like showed how powerful token incentives are, and I think, you know, like I said, that's an opportunity to be harnessed. And I don't think, you know, DeFi is using them in the right way right now. Like I think a lot of the rewards are placed in such a way that it's, you know, very short-term rewards and aren't kind of built to incentivize a more sustainable and like long-term building of the product. But I think, you know, that'll start to change. And I think it's a good lesson to learn that, wow, these things really drive a lot of activity and liquidity.
Got it. Great. Well, thank you so much, Camila, for joining us. That's all the
Thank
time
you.
we've got. We're going to call up our next speakers, but really appreciate you taking the time. Everybody check out The Defiant. Go read Camila's book. It's great.
Yay. Thanks so
Okay.
much.
Thanks very much.